So in this video, we're going to talk about market structure. Now, what we have to understand is that the market will move in waves, okay? The market can't just move in one direction straight up. At some point, it has to have relief. So with this comes up moves and down moves. And I'm going to delve a little bit deeper into what they potentially mean. So what we have here is effectively a zigzag to you guys. Now, what I will do is I will go over to an actual live market and I will actually show you this sort of scenario. But firstly, what we have to understand is what this means. Now, what we can see is we can see these peaks at the top and we can also see these bottoms here. Now, what we can use to understand what is going on here is we can use these highs and these lows. Now, when we have a high that's created and we've got a low that's created, if we then get price moving above this prior high and it then creates a new high, we then create what's called a higher high. Okay, that's important because this can effectively show us what a trend is. Now, in this example here, we've got a high, we've got a low, we've got a new high which broke this prior high, and we've also got a new low which is higher than its previous low here. So we have a high, we've got a low, we've got a higher high, and then we've got a higher low. So this is a basic sort of uptrend because each high is higher than the other and each low is higher than the other as well. Now, in this example here, this would be an example of a downtrend. Now, if we just reverse engineer what I just told you, we can then use that in order to understand why this is a downtrend. So we have a low that's created. We then have a high that's created. We then have a new low that's created. So this low is lower than this previous low. We then have a new high that's created. And this high is lower than this one that was previously created. So what we have this high, we have a low, we have a lower low, and then a lower high. And this is our standard downtrend. So every low is lower than the previous one, and every high is also lower than the previous one. Now, why is this important? So this sort of structure can help us understand where price is going and potentially allow us to understand where price moved to before potentially going further. So I'll explain a bit more in depth and I'll use the example of an uptrend. So for our uptrend, we have an up movement, we have a down movement, we have an up movement that breaks the previous high, we have a down movement that fails to break this previous low, and on and on and on. Now, within each of these sort of movements, what we have to understand is there are different phases. So we have this movement, which is the movement that creates a high, and then we've got another movement, which is the one that creates a low. Now, what we have to understand here is that the movement that creates a low is a lot shorter than the movement that creates the high. Now, this is where the waves of price movement come in. So what we have here, this move up, this is called an impulsive move. Okay, so this is moving quite fast in the direction that it wants to travel. And then we then have this second price move, which is shorter than this impulsive move here. This secondary price move is called a correction. So price is then correcting very slowly to the downside before we then shoot off again and create another impulsive move. Okay. Once we create our impulsive move, we then have to correct. And this is the relief phase. Because like I mentioned before, we can't just go up in one straight line. At some point, we have to have a relief phase. Now, the way we can tell what's an impulse and what is a correction is that the impulse waves are bigger than the corrections. And also, these corrections tend to take their time. They tend to take a bit longer than the impulse waves. Okay, now with that in mind, we can then use this naked price structure in order to give us an idea of where price may potentially go. So what we can see here, we've got an impulsive move to the upside, which is this leg. Then we've got this corrective move to the downside. Then we've got another impulsive move to the upside. Then a corrective move to the downside. Boom, we've got another impulsive move. Now, what can we expect? What have we seen here? We've seen an impulsive move there. We've seen an impulsive move there. We've seen a correction after the impulse and a correction after the impulse. Now, when we get another impulsive move, what can we then expect? Well, we can then expect another corrective move. And then when we have this corrective move, what happens after the corrective move? Boom, impulse. And we can expect price to move to the upside. So now with the impulse and the corrections in mind, we can then take this onto a candlestick chart, and this will really show us how price actually moves, because it's all very well just using up arrows and down arrows, but in actuality, price isn't as perfect as those examples before. So onto a live chart here. Now I'm just going to start from this high and this low, and let's see what happens. Okay, so what we can notice here, we've got our high, we've got our low, we've got a move up, we've created another high, but we failed to break this previous high, and then we've come down and we've created a new low. Now with that in mind, having this high, this low, this lower high, and this lower low, what can we then expect to happen? Based on the examples that I showed before, if we're creating lower highs and lower lows, we can expect more lower highs and more lower lows to be created. So we move price on. Boom. Lower high created, new lower low. Now notice in this movement down over here, how long does it take for price to create the low? It takes 1, 2, 3, 4 candles. And then how many candles does it take to then create the lower high? It takes 1, 2, 3, 4, 5, 6, 7, 8. Now it's almost taken the double the time to create that movement there as it has to create the low. Now, based on what I told you before about the impulses and the corrections, the impulses are a lot longer and faster than the corrections. The corrections take probably double the time. And in this case, you can see that is spot on. It's literally taken double the amount of candles to create this lower high as it has to create this low. Once again, impulse down takes a lot longer to do the correction. And boom, new impulse down. So what can we start to then assume? We're going to then get another correction? Let's see. And once again, this high has failed to break the previous high. So we've then got another lower high, and we can then start to expect another lower low. Now, at this point, this is where we can understand how to potentially go about taking trades. Now, one thing that we do have to understand is price will never always just do this. It won't just go up, down, creating lower highs and lower lows all the time. It won't do that. At some point, it'll create a low that fails to break the previous low. And then all of a sudden, boom, we get a high that breaks the previous high. And that is when we get a change in structure, and we can then start to change our bias. Okay, so let's say price moved up here. It creates a new high. It fails to create a new low. Now we've got low, higher low, high low, higher high. We can then expect a new higher high to get created. This is how we can go about looking at structure and how we can potentially gain a bias from structure.